Great that you're here for the inaugural virtual tag seminar for Catholic Charities. Um, I have known Mark Lober for many years, probably 10 years now, I would guess. And he works with our legacy office. He's a part of the advancement group. He is a big part of the advancement group and also Tulsa Community Foundation's initiative to help nonprofits understand estate planning and help families who are wanting to look at estate planning. Mark has got over 34 years of experience in this. He is a guru, and there's never been a wonk like Mark. When you get him going on a specific topic, he just drills down further and further until you've got to say stop, stop. I can't take it anymore. So he's the man with all the knowledge on financial and charitable gift planning, and that comes from a long service with the Oklahoma Plan Giving Council, where he's been in pretty much all the officer roles over the years. It comes from him going back into the 90s with the Association of Charitable Gift Planners and the Financial Planning Association. And so he's got a huge wealth of knowledge and a team that stands behind him on that. Mark, going back way back, was a board member of Regent Bank. He was on the Executive Trust and Loan Committee. He went to ORU, so we know he is a good man behind the business piece. He's got great formation. He went to the ORU School of Business, and then later he studied estate tax, wills, and trusts, and the tax and economics of charitable giving at Regent University Law School in Virginia. So I give you most of that, but I would say that beyond all that, I have found Mark to be an incredibly great guy to work with, both from the seat of a CEO, but also as a client, if you will. I went through this process with Jennifer, my wife, knowing that we were at risk if we were driving down the road and a truck clipped us and we couldn't make it home. We wanted to be sure that our children understood what our values were and that they were taken care of. And Mark helped us through every bit of that to get us to the place where we feel comfortable now. We still say our prayers and hope that we'll return home every night, but we know if it's God's will, Mark's got us covered. So with that, let me give it to Mark, and he'll run through his component as Chris Miller, the co-host and tag guy as well. Chris said if you type some comments into the comment box, the chat window down there at the bottom, that they'll be able to answer your questions. So feel free at any time to type into the chat window. Go for it, Mark.
All right, Kevin, thank you. And Lori as well. I really appreciate the opportunity of working with Catholic Charities. Wonderful organization, and you guys are impacting a lot of people's lives. And I can only imagine what's happening now with the pandemic and the demands placed on Catholic Charities. So my role is in the legacy program, as Kevin said, and feel very comfortable working in this area. We want to bring you up to date on some changes in the tax laws that affect everybody on our meeting today. Pretty substantive changes. In fact, I'll just say that they're probably the most significant changes since the 2006 Pension Protection Act. And you can roll back into the 1986 Tax Act, which was a major tax bill then. There are some changes here in this particular, or these two tax acts that we're going to take a look at. My objective is to really give you I don't want to drill too deeply into it. I've got to give you some background into it. But my objective is to make you aware of how this will impact you and things that you can do to be a better steward of those resources that you have from a planning perspective for your finances, for your family, and also to include those faith-based organizations and philanthropic organizations that you would like to potentially give to. So with that, what I'm going to do is I'm going to share my screen. I've got a PowerPoint presentation. So I'm going to walk you through that. And again, if you have questions, feel free to type them in the chat bar, or you can send them over via email to Lori, and then I'll be more than happy to follow up on any of those. And at the end, if you would also like to take advantage of the service of this program, I'm here to serve you guys. I'm not selling anything. So if you would ever like to get together, we can visit virtually via Zoom. We can do it over the phone. If you decide to meet face-to-face, we can do that. And we follow all of the CDC guidelines. So we want people to feel comfortable that if we do meet face-to-face, that you would not be concerned of being placed at risk or anything like that. All right, so with all that being said, let me switch my screen and hopefully you're going to be able to see that. Give me a nod there if you can see my screen. And it should be a blue screen for the Secure Act and CARES Act. Does everybody see that?
No.
You do not?
No. No. No, he should be able to see it right up there.
There it goes.
You got it now?
Okay, now it's there.
Okay, there it is.
Yep. All right, so what we're gonna do is I'm gonna start jumping into this. Let me tell you where we're gonna go. See if I can get this working. There we go. And thank you for the intro there, Kevin. I appreciate that. What we're going to cover very quickly, I want to talk about several developments that happened in DC affecting the retirement plan. So we're going to take a look at a bill that was passed, a law that became into law, a law that was passed in December of last year. And it was called the Secure Act. So we're going to cover that. And then we're going to go into a bill that was just passed in March of this year. December feels so long ago. It's amazing. I think 2020 is going to be an adjective that we'll be able to look up in the dictionary one day. So Deacon Kevin, don't go 2020 on me. or that's still 2020.
Keep it clean, keep it clean.
Yeah, that's it, yeah. But I think this is gonna get out in the books and definitely be a line of demarcation in our history, the world's history. So, and then I also wanna take a look at a couple of very important recent court rulings that affect your retirement accounts as well. Pretty important. And then I want to hit the different phases that you go through on a retirement account. And I'll call those withdrawal phases, and then I'll even talk about the transfer phase. So we'll hit that as well. There are new rules with respect to the distributions. And then I want to hit a couple of things on making gifts from IRAs that actually can place you in a better position financially. It can impact your adjusted gross income, which could then therefore impact the Part B premium that you pay and how much of your Social Security is subject to income tax. And then lastly, how to navigate this area called the Qualified Charitable Distribution post-Secure and CARES Act. So I've got a little bit of material. We should be able to get this knocked out here in about 35 minutes, and we'll go through it. So the DC highlights the Setting Every Community Up for Retirement Enhancement Act. Again, it was passed on December 20th, but the biggest change there is the required minimum distributions that you may be aware of that used to be 70.5 is no longer the case. It's now age 72. So if you turned 70.5 in 2019 or before that, you still need to take your required minimum distributions. And I'll talk about an exception, but if you were 70.5 prior to 2019, you're subject to taking your RMDs. Those born after July 1st of 1949, or those turning 70.5 in 2020 or later, you can wait until age 72 until you have to take your RMD. So that is a big change. It's allowing us to grow those dollars. Life expectancy is pushing out a little bit more. So it permits those dollars some time to continue to grow. So that was a big change in the Secure Act. I think the most anticipated part of the Secure Act that has been watched by the philanthropic, the financial, the legal, and the tax community had to do with this area called the Stretch IRA. This has nothing to do with you while you're living. This is an issue upon the taxation of retirement accounts when someone receives the retirement account as a beneficiary. Under the old rule, if I left my retirement account to someone other than my spouse, they could take the value of that retirement account and take their life expectancy. So let's just say my child is 40 and has a 50-year life expectancy, and I have a $100,000 IRA. If I take 50-year life expectancy and divide that into $100,000, that's $2,000 that was required to be paid out. Then the next year, you decrease the 50 life expectancy by 1. So the ability to stretch that $100,000 out over the life expectancy of a non-spousal children beneficiary has now been eliminated. Now the requirement is there are no required minimum distributions upon the death of the plan owner when it passes to a non-spousal beneficiary. The rule now is all of the money in that retirement account has to be distributed within 10 years. It must be out of the account within. So now this ability to defer taxes and grow the money in this tax sheltered environment is now gone. That is a significant impact. Let me just say this, the House version is the version that passed and became law. The Senate wanted to reduce that to 5 years. So if you have $100,000, that money had to come out of the account within 5 years. The House version passed. With all of this money that's been being passed out from Congress right now, I would expect, and there are several bills that are out there right now, that 10 years will be reduced down to 5 years. That I really see that happening because Congress views this as money that's never been taxed. It's a great place to go get some money to help reduce some of the spending that's going to be happening going forward. So that was the most significant, I think, from a planning perspective, was the elimination of the life expectancy stretch IRA to non-spousal beneficiaries. One of the other things that's beneficial is many seniors are going back to work or continuing to work past age 70 and a half. And prior to the passage of this bill, if you wanted to make a contribution to an IRA, you were not permitted to. So now, if you're working, which means you have wages, you can make a contribution to an IRA if you are 70 and a half years of age and older. So that gives you the ability to reduce your taxable income and also continue to grow some dollars in a tax sheltered environment. So that's a pretty attractive little benefit as well. Another feature was the Coronavirus Aid, Relief, and Economic Security Act. This was the second major bill that passed in March of 2020. And it basically, as we talked about before, the required minimum distribution changing from age 70 and a half to 72, this deals with the required minimum distribution for 2020. Congress said, the way you calculate that RMD is you take a look at the value of it on January 1. Well, January 1, if you had $100,000 and you were truly just in the S&P 500, by March 23rd, that $100,000 account dropped down to about $60,000. There was a 40% reduction in the market. The market dropped 40%. Congress immediately came in with a stimulus bill, the CARES Act, and said, listen, we don't want people to have to take a distribution based upon the value of January 1. We want to let them have their retirement accounts heal. And so we're going to waive the requirement in 2020 to take your RMD. So in the year of 2020, we are not required to take, if you're subject to taking RMDs, that has been waived for 2020. We don't know what's going to happen in 2021 yet, but obviously the market has healed and it did that V-shaped recovery, and it's disconnected from the economy. The sort of Wall Street and Main Street are somewhat disconnected, decoupled, but nonetheless, that retirement account, if you did not panic and get out at the bottom, has definitely come back and healed itself, which was the entire intent of waiving that RMD for 2020. This is a wonderful, wonderful gift that is given to the American taxpayer. This new $300 above the line charitable deduction for non-itemizers. What in the world does that mean? This means that it's an above the line deduction. So this is done whether or not you itemize. It reduces your adjusted gross income, which is used to calculate a lot of different things on a person on your when you're filing your tax return. So this is considered an above the line deduction. It reduces taxable income if you itemize or if you don't itemize. But what it really, really does is it levels the playing field for high income taxpayers and low income taxpayers, because we both benefit by the fact that our income is reduced before calculating taxable income. This is limited to $300 if you're single in 2020, $600 if you're a married couple. And this is also has a phrase that you're going to hear a lot more about, I think, in 2021. This comes under what is called the Universal Charitable Income Tax Deduction, the UCD, the Universal Charitable Income Tax Deduction. Senator Langford here from Oklahoma, along with a bipartisan group of senators, have introduced legislation to increase this $300 charitable deduction to, if you're an individual, to a $4,026 deduction, or if you're married, $8,052. So why those odd numbers? Because it's 1/3 of the standard deduction. So if you itemize, or excuse me, if you do not itemize, if you're a non-itemizer, the universal charitable deduction reduces your taxable income. So it reduces your adjusted gross income, which affects your taxable income. This is a wonderful strategy. Why did Congress, what was the rationale for this? Congress wanted to be able to push money into the hands of charities like Catholic Charities that are on the front lines, having tremendous demands placed upon them during this pandemic. And they said, listen, we want to encourage people to do this. So they just said, let's give everybody, whether you itemize or not, we're going to give you an above the line charitable deduction. And but it has, there were a couple of caveats. It has to go to a charity, and it must be cash. You can't use appreciated securities or real estate, appreciated property, things like that. It has to be cash, and it must go directly to the charity to get it to those frontline organizations that are there helping people during the pandemic. So we're going to hear more about this, I know, in the future. I'm following some legislation right now. It's called the Universal Pandemic Response Act. That would be increasing this from $300 to, again, $4,000 and $8,000 respectively for individuals or married filing joint. So that's a big game changer. The other thing is it increased the adjusted gross income. So if we go back up to this above the line charitable deduction, this is one of those variables that affects AGI, your adjusted gross income, which then calculates your taxable income. So if I make $50,000 a year, and if I wanted to give away $50,000, all of my income, I would be limited to how much I could actually deduct this year. I could deduct 60% of my income. So if I gave away $50,000 of my income and I make $50,000, I could only deduct $30,000 of that. I'd have to carry over that deduction into the future tax years. What Congress said is, again, we need to, those people that are philanthropic and those people that have means, we want to encourage charitable giving, especially in this pandemic. If somebody wants to give up to 100% of their income, we will give them a 100% deduction. So we have this deduction this year that is up to 100% of AGI. And that's a wonderful opportunity for those that have the means to do that. That is limited to 2020. the 100% charitable income tax deduction is limited to 2020. The 60% charitable deduction, 60% of AGI reverts back to 50%. It's generally been 50%. I mean, I've been doing this since 1986. It's always been 50% of AGI as it relates to cash. It reverts back to that in 2026. And why 2026? Because the Tax Act that was passed when President Trump came into office expires. All of those are lower tax brackets, and I'm going to go this in a second. Our lower tax brackets and all that, they revert back to what they were prior to the Tax Cut and Jobs Act. So we will be reverting back to the 50% of AGI. So right now until 2026, we have a 60% AGI limitation. For 2020, it's 100%, and it reverts back to 50% in 2026. Let me just apply this very quickly. I'm going back to this stretch IRA issue under the Secure Act. So if you have a retirement account, you have a bullseye painted on you. Congress has basically said, we're coming after your retirement account. Our ears are pinned back. We're going to begin taking 40% of every dollar that you have in your retirement account when you pass it to someone other than your spouse. And we used to have, remember the estate tax? It used to be the death tax. When I started in 1986 in this whole area, that if you had more than $600,000 of assets, your house, your checking, your savings, your retirement account, the death benefit of life insurance, put that in a bucket. If it was more than $600,000, Washington taxed the next dollar when you gave it to your children or when you passed away at a 55% tax rate. That death tax, in order to pay the death tax today, you have to have over $11.5 million for a single person, almost $23 million as a husband and wife. That's 0.01% of the population. And anything above those numbers are taxed at 40%. Well, Congress said this death tax is so controversial, let's just go after retirement accounts. Let's just go ahead and put a 40% tax basically on a retirement account. So, which represents about 25 to 30% of the population. So we're taking the focus off the death tax at 0.1% of the population. We're going to go after 30% of the population who have retirement accounts of about $250,000 or more. Well, that represents about a 37% income tax for Washington. Well, bingo, you're 4% on $200,000, $80,000 tax bill, just on a $200,000 retirement account. So Congress is coming after these dollars, and they're really serious about it. Charity can solve all of that. So let me go back and talk about this. So when you pass away, the death of the plan owner, we have these whole new categories, guys. This gets a little deep, but this is very simple with the graphic. You have eligible designated beneficiaries. Therefore, if you leave it to your spouse, your retirement account, primary beneficiary spouse, a minor child, someone under in the state of Oklahoma, younger than age 18, or a beneficiary not more than 10 years younger than you. My brother, for example, he's not more than 10 years younger than I. Or someone that is disabled or chronically ill, the beneficiary, that beneficiary is defined in the Internal Revenue Code. You have to meet the requirements of chronically ill or disabled. If you leave your retirement account to any four of those individuals, they can continue to take it out over their life expectancy. So a spouse can continue to take required distributions over their life expectancy. A child can take it. So if you have an 8-year-old child, they're the beneficiary of a retirement account. They can take their life expectancy of 80 years and begin taking these required minimum distributions. But as soon as they turn age 18, we're back into the 10-year rule. That money has to come out by the end of the 10th year. So now what we do is we have these non-eligible designated beneficiaries. Well, who's a non-eligible designated? It's everybody else other than an eligible designated beneficiary. So non-spousal beneficiaries or certain trusts and your estate if you have not named a beneficiary. So what happens now? Those beneficiaries the retirement account must be paid out by the end of the 10th year. Let's go to our $100,000 IRA. I'm not required to take a distribution year 1 through 9, but by the end of the 10th year, that 100,000 has to come out. I can pay all the tax up front, take the 100,000 out and pay it in year 1. I can take 1/10 every year. I can take some money, skip a couple of years and take some more, but it all must be out by the end of the 10th year. More than likely, that is going to reduce down to 5 years. So part of the educational opportunities that we have here, Charities can eliminate the 10-year payout, and we can go back to the lifetime stretch, but only if you include charity. So what we've been, let me give you one of the things that Deacon Kevin said is I took a class called The Tax Economics of Charitable Giving. Most people, I think, fell asleep in the class, and I don't know why I got excited. But here is the benefit. And remember, I sat on the board of a bank. Here's the concept. If I send money to Washington or down to Oklahoma City in the form of taxes, I lose that money forever. So if I am a non-eligible beneficiary and I have to pull that out by the end of the 10th year, I'm going to have to pay $100,000, 40%, $40,000 in taxes. That $40,000 is gone forever. What if I didn't have to pay that tax? If I did not have to pay that tax, I now have $100,000 versus $60,000. The use of that $40,000 can create more wealth for my family, and it can benefit charities. So here's what happens. Here's our third. We can use this thing called a charitable remainder trust or charitable gift annuities to name as a beneficiary of a retirement account. Watch the power of this. You can stretch over the life expectancy of the beneficiaries if they qualify. There's some tax rules there that we have to meet. Number 2, you get asset protection. That retirement account, and I'll talk about that in the next slide, that retirement account is now asset protected. Thirdly, there's more money for the beneficiaries. Rather than 60%, they get 100%. What would you rather do? If I have $100,000 earning 5%, that's $5,000 a year. If I have $60,000 earning 5%, that's $3,000 a year. 6,000 is better, 5,000 is better than 3,000. So there's more money there for the beneficiaries. And we can disinherit the IRS in Oklahoma. Those taxes can be eliminated now, that $40,000 immediate tax. And you can choose your charity. You can give the $40,000 to Washington, or you can have more available for your children or your heirs, and then make a gift to charity. So this is a planning opportunity we'd love to be able to sit down and talk to you about through the legacy department. But I think this is probably the greatest planning opportunity to preserve the stretch, save that money, to create more for your family, and also philanthropy and your faith-based organizations that you want to give to, because all we're doing is disinheriting Uncle Sam and keeping that money for your family. All right, a lot of information. Okay, I'm going to pause for a second to let your brain catch up. And let's go to one more area here. There are a couple of tax court cases that passed. Let's take a look at the first one. The one rollover per year. You're only permitted to roll over money from an IRA to an IRA, a 401k to an IRA. You're only allowed to do that one time per year. And it's limited to a 60-day rollover between IRAs in a 12-month fiscal year period. Fiscal year means whatever day during the year you do the rollover, you must wait 365 days. This is a huge mistake, and I've seen it happen since this court ruling occurred. For example, March 31st, or let's say April 1, I roll over my IRA, and then later that year, I do another rollover. Or excuse me, January 1 of the next year, I do a rollover. You did not meet the 12-month fiscal year period. You are not eligible. If I make a rollover on April 1, you are not eligible to make a rollover again until April 2 of the following year. Okay? That's a big potential landmine when people are doing rollovers. The new rule is applicable to IRAs, SEP IRAs, Simples, and Roth IRAs. So it's limited to IRAs only, not 401k to IRA. You still can do Fidelity to Charles Schwab, Merrill Lynch to Edward Jones. You can still go trustee to trustee unlimited, but your 60-day rollover is limited to one per year. This Supreme Court case that happened with Clark versus Ramaker was a big deal. And it ties right back into the stretch IRA concept. When you leave money to a non-spousal beneficiary, that money used to be protected. Under the Bankruptcy Abuse Protection Act of 2005, IRAs were exempted assets. I'm going to go back to a sad moment in our country and the whole case of, remember the O.J. Simpson case? And because most of us remember O.J. Simpson, the very infamous helicopter ride and flying over and seeing the Bronco going down the highway in California. But at the conclusion of both the civil and the criminal and the civil trials, the family came after O.J. Simpson in the civil trial. They were able to get, I don't remember how large the settlement was, but they were able to get a lien against him. What was protected? His IRA and his pension. Today, if that money, if he had inherited that from his parents, his IRA would have been able to satisfy that lien against him or the claims of those creditors. That is not, so IRAs are no longer protected. The IRS views, or excuse me, this tax court case treats a retirement account like any other asset that you own. It is a chunk of money that can be attached by the claims of creditors. The reason why I bring this up as well, when we use charity in protecting or eliminating that 40% that goes to Washington, we can eliminate that tax and preserve the stretch like we talked about under a charitable remainder trust or charitable gift annuity. These are done at death. So when I die, the beneficiary is the charitable trust. The trust now pays my kids. When it's in that charitable trust, I get both the ability to eliminate the tax immediately. I can stretch it out over the life expectancy of the kids, and it's asset protected again. I got the three big things that we wanted back as a result of including charity in your planning.
Mark.
Huge opportunities, big issues to deal with. And so again, we're here to sit down with you, talk with you about these planning opportunities to provide more for you, more for your family. Choose your charity, Uncle Sam, Anna, Oklahoma, or Catholic Charities and other organizations that are on your heart.
Mark.
Yes, sir.
There was one question on the third example for that CRT and charitable gift annuity.
Yes.
Is the charity the beneficiary or is the spouse? Can you answer that for us?
Okay, yes. The spouse, if you're married, you're generally going to leave everything to your spouse. When the surviving spouse passes away, rather than naming the child, well, let me say it this way. You could name the child and you could name the charitable trust. 50% to the charitable trust, 50% to the child. So your primary beneficiary on the retirement account is spouse. So if I die, everything's going to go to my wife, Michelle. But upon my wife's death, we could give, if I have a $100,000 IRA, I can give 50% to my child and 50% to the charitable trust. That charitable trust is the portion that would eliminate the tax, give the life expectancy, stretch calculation, and I get the asset protection. Here, the child has to have it out by the end of the 10th year under current law. Good question. Okay, I'm going to change gears and go back to the Tax Act that passed in 2017, became law January 1 of 18. This is the tax environment or the landscape that we live in today. And I just want to very quickly hit what are the tax rates right now. We've got 7 brackets, 10, 12, 22, 24, 32, 35, and 37. The 12 goes back up to 15. Remember, this expires at the end of 2026 or at the end of 2025, January 1 of 26. Okay, so they go back to the old rates. So we're in a very, very low tax environment right now. So that's something to keep in mind, that this will be expiring. Capital gains rates are anywhere from 0 to 20%. You have a net investment income tax that pays for the Affordable Care Act that you have to add back on top of the 15 and 20% capital gains rates to the extent that you have a capital gain item. And then you have a tax top corporate rate is now at 21%. As well. So we're in a very, very favorable tax environment today. And as mentioned earlier, those all sunset or they expire December 31st, 2025. And there was a rationale as to why Congress did that. What they did to encourage corporations to invest in building factories and making large capital investments for equipment and machinery. Businesses have to be able to look beyond 3, 4, 5 years. So what they did under the Tax Cut and Jobs Act was make the corporate rate at 21% permanent, and they made the individual rates temporary so that we revert back to the higher ones in December 31st of 2025. And the rationale is it's going to be difficult to raise taxes on people, so they didn't think that they would increase. But that's they kicked the can down the road, and they gave it to where corporations could plan for the long term. Individuals, hopefully, the Congress will not. They will vote to continue to extend the lower rates. That was sort of the rationale. So here's our standard deduction. And if your filing status is single or married filing jointly, you got a $12,400 and $24,800 for 2020. This is a big deal because prior to the Tax Cut and Jobs Act, about 70% of Americans were taking the standard deduction. Well, that's closer to about 93% of Americans are taking the standard deduction. And why is this a big issue? Let's go back to that $300 single, $600 husband and wife universal charitable income tax deduction. Because if you are giving to charity today and you do not itemize, you're not getting a tax advantage for that. What this is doing is, it's just like you can put water dripping over thousands of years and have it drip on granite, and eventually it's going to make a divot. This is a chipping away, a constant chipping away of this universal charitable income tax deduction that literally, again, it levels the playing field for everybody and all Americans to encourage charitable giving, whether or not you itemize or you take the standard deduction. Because if they can increase that thing from $300 to $8,000 for a husband and wife, you can give to charity that up to $8,000, reduce your taxable deduction, reduce your taxable income or your adjusted gross income, which affects your taxable income, and you still get a $24,800 standard deduction. In other words, that's like getting a $32,000, almost $33,000 deduction. It's a huge benefit. So anyway, that's the standard deduction. And there's the impact of that. I guess, 31% we're itemizing. Now we're it's actually closer to about 9, 10, 11, 12% last year. So it's probably going to be a little lower than that this year.
Mark.
Yes, sir.
Here's a great question for you in regard to those tax rates. What could happen with what you're talking about and what you've said if the Republicans lose control in November?
With respect to the tax rates, you can go out and read the tax policies of both parties and see that they're dramatically different. In fact, this morning I was reading an article early, and just to contrast, the Republican Party saying that the rates that you see on the screen will be extended The Democrat Party is saying that no one below $400,000 will see an increase. People that are making, have taxable income of $400,000 and higher will see a 1 to 2% increase, and that represents about 1.8% of the taxpayers in America. So if you're making $400,000 more, you're 1.8% of the Americans. Then what they're saying is that 1% is going to gradually go up to another additional 5%. So I think you've got a contrast in how the income tax policy will play out. And what does that mean? I mean, you know, the market will tell us what that means, and the stock market and business will tell us what that means with respect to to that side. So I'm just reporting facts in terms of rates, and then you guys can make the political decision from there. All right, that's a good question though. So itemized deductions, gifts to charity, 60% of AGI. This year it's 100%. State and local taxes are capped at 10,000. So you take your state income tax, your real estate tax, and add that all together, you're capped at 10. If you have mortgage interest on a loan that's less than $750,000, so if you have a loan that's less than $750,000, the interest is deductible. Any portion of the loan in excess of the $750,000 is non-deductible. Your medical expenses, they changed that from a historical 7.5% of adjusted gross. This is one of those areas where adjusted gross income is affected by the universal charitable income tax deduction. Anyway, it's not the first, now it's the first, that should not be not, that should be now, it's the first 10% of your adjusted gross income you cannot deduct. So if I have $10,000 of medical deductions, the first 10% or $1,000 is not deductible if I'm itemizing. Anything above that is deductible. So that's sort of an overview of itemized deductions, the most popular. This is what they call the SALT deductions. Let me switch gears and go back to retirement accounts because that's sort of the theme of what we're talking about tonight. Let me go to the withdrawal rules very quickly. So think about this now. If you have a retirement account and you're younger than 59 and a half, okay, if you took anything out of that retirement account prior to 59 and a half, you'd have to pay taxes on it. Uncle Sam wanted an extra 10%. It was a penalty. It was an excise tax for early withdrawal. They did not want you to withdraw money from that retirement account prior to 59 and a half. There are a couple of exceptions. There's code section 72T, and this is very important for any of you that are working for an employer that has and you have a 401k. This is important. So we're familiar with the substantially equal periodic payments. So you have to take it out. You can spread it out over 5 years until you turn 59 and a half. But the one that's overlooked, that's very rarely used, is if you're 55 years of age and older, you separate from your employer and you have a 401k, and if the money is in your employer's 401k and you're 55 and older, I just said what I just said backwards. So you go, but so if you meet those three criteria, you can pull money from that 401k and not be subject to the 10% penalty. That is very important. Section 72T. It's a very, very important planning strategy that I help people with. Here's the other one. Prior to 70 and a half, there's no penalties between after 59 and a half to 70 and a half. That is the neutral zone. You're in Switzerland. Anything that you take out is only going to be subject to confiscation by Washington and Oklahoma, but there's no penalties. After 70 and a half, you have to begin taking withdrawals called a required minimum distribution. What did the Secure Act do? It changed that to what? Age 72. So all across the board now, we're able to defer those dollars from 59 and a half to 72 before we are required to take the distribution. There are a couple of exceptions beyond 72. To the extent that you are working and you're participating in a 401k, listen to this, if you are working and you are participating in a 401k, you're not subject to the RMD. But you have an IRA sitting over at Ed Jones or Merrill Lynch or Wells Fargo. You're required to take that distribution if you're 72. How can you avoid it? I'm able to not take my RMD from my 401k, but I have this IRA that I'm required to. All you have to do is roll the IRA into your 401k. You continue working, you're not required to take that RMD until you separate from the company. So there's a planning strategy, planning note. If you have an IRA and you're working, you can roll that IRA into the 401k and not be subject to the RMD. Unless you are a 5% or more shareholder, sorry, you have to start your RMDs. Okay, let's finish this up here. What do RMDs look like? So here's your age. When you turn 70 or 72, the payout rate's 3.9%. As you age, our life expectancy is getting shorter. Congress is pushing more and more and more of that money out on a percentage basis. So if I have $100,000 at 80, I have to take $5,300. Contrasted with I have 72, I only have to take $3,900 off of that account. But if I'm 90, I have to take $8,800 off of that account. So you will be eating into the value of that retirement account Uncle Sam once paid, because they gave you this ability to shelter all this money from tax for such a long time. They want some money back now. What does it look like? How do you calculate that? Here's your here's the uniform lifetime table to calculate it. You can pull this up and there's your 3.9. So there's your life expectancy tables. So what's amazing, at age 79, life expectancy is still 19.5 years. Age 85, it's 14.8. At age 90, it's still 11 years. At age 95, the longer you live, the longer you are expected to live. So it's not as if you determine your life expectancy today and it's fixed. The longer you live, why is that important? All that I'm talking about today is dealing with your retirement account and how it is surrounded by alligators and taxes. We have to be cognizant of the fact that those retirement dollars, we have to plan for them so that we are not going to outlive them and we can continue to meet your needs into the future. Thus, your legacy department is here to help you through that and help you take these things into consideration. So then the last thing is, how do we calculate? Take a look at here. I'm just highlighting that number right there, 72. Whoops, let me go back to that. See where I've highlighted 25.6? Let's apply how we calculate the RMD. This is a very, very simple calculation. I'm going to take you guys back into your mathematic days in school. So what you do, number one, you have to take a look at the value of that account at the end of the year. Number two, you simply go to the life expectancy table, grab the life expectancy. And then number three, you have to take the RMD by 12/31. There's a little bit of rules in there. I'm not going to go too much into depth, but basically by 12/31 of that year, you turn 72, you have to take your RMD. So what's that look like? Let's calculate it. Here's your retirement account balance divided by life expectancy. The required minimum dollar distribution must come out. So let's use an example. Bill's 72. There's his 100,000. We grab the 25.6 from the table. He's required to take 36.4964. Next year, we can go to the table, grab his life expectancy, grab value on January 1 or 12/31, either one, divide that into the life expectancy into the value, and that tells you your RMD. Okay? I have some folks that I work with that literally come in every year. They want me to check their math on their 8 different IRAs. And so it's fun, but there's your calculation in calculating your RMD. Here's the problem, guys. Don't forget to take the RMD. If you do, you not only get to pay the income tax, you have an excess accumulation tax of an additional 50% penalty. Highly punitive. Don't forget to take the RMD. IRS is a little forgiving for the first year. So it's called your required beginning date. They're a little forgiving. And so what that means is if you make a mistake, you can file a form, plead for forgiveness. They usually provide mercy. After that, they're coming after their 50% penalty. So with exceptions. So put it on your reminder. 72 is the new RMD date. Don't forget, and make sure that you do that. There's going to be a little bit of challenges, I guarantee you, in 2021, because number one, we've got new rules. Number two, RMDs were suspended. Now what's going to happen? Will those that are subject to RMDs, will they automatically turn back on? Do you have to reach out to turn them on? I mean, this is a big planning issue. So if you're subject to an RMD, you need to be thinking about it in 2021. Okay, the last thing I'm going to finish up with here in about 3 or 4 minutes is what's called the qualified charitable distribution, otherwise known as the IRA rollover to charity. Great planning opportunity. This affects so many things for you guys. This is a wonderful strategy. What is it, first of all? The QCD, the qualified charitable distribution, is any distribution from an IRA made directly by your custodian to charity. Remember, I said who, now look what I put in red. Who's 70 and a half and older? That did not change. You are eligible to do a QCD if you are 70 and a half and older. You do not have to wait until 72. 72 is when you take your required minimum distribution. I'll tie that back into this in a second. So you can take, so here's what it works. Eligibility. You're eligible to exclude the distribution from income. Again, if you take money from that retirement account, you do not recognize it to income. And the value of that is, well, let me just finish that. The value of that is, if you give to charity and you can't itemize, you're going to still have to recognize that as income. So you're going to have to pay tax on it, but it's still under your standard deduction. You didn't get a benefit. By giving the gift, listen to this, by giving the gift as a QCD, you don't have to recognize it as income, and you still get your standard deduction. And in addition, the impact of that is it may push you up into a situation where you have to pay more on your Social Security. It could move you from having 50% of your Social Security benefits taxable to 85%. This is a wonderful strategy to minimize that. Secondly, it also reduces the increase on the premium for your Part B Medicare. If your adjusted gross income exceeds certain limits, they start increasing your Part B premium. When you begin taking RMDs, then that could push you up and exceed that portion of Social Security that is going to be subject to income tax. That also affects your Part B premium and increase your premium. So this is a wonderful strategy to minimize that. The exclusion applies to individuals who have reached age 70 and a half by the date of the distribution. In order to do a QCD, you must physically chronologically be age 70 and a half and older. It's not the year in which you turn 70 and a half. I turned 70 and a half in March 1, and if I make a QCD prior to March 1, it is not a QCD. My birthday is March 1. 70 and a half is September 1. I have to be 70 and a half before I can do a QCD. Big landmine. People make mistakes because it gets confusing with the RMD, the year in which you turn 70 and a half. Okay, check the calendar for your age when you're doing a QCD. Requirements, very easily, you must be, it's an outright lifetime transfer. So this is done during life. It's an exclusion from your gross income from otherwise taxable IRA distribution. So when you take that money out of that retirement account, Uncle Sam wants a share, you give it to charity. Rather than writing a check out and giving it to charity, Call your broker, have them write the check out to the name of the charity. They'll send it to you, put it, drop it in the box and give to charity. That check's payable to charity, and you do not recognize it as income. Again, you must chronologically be 70 and a half and older at the time of the QCD. When you turn 72, your required minimum distribution qualifies as an exclusion from income, which again goes back to potentially reducing taxes on Social Security and reducing your Medicare premium increasing. And you don't recognize it as taxable income. So the RMD at 72 qualifies up to $100,000 per year per plan owner. So if you have an RMD of $3,600, don't take the RMD into income, pay tax on it, and you're taking the standard deduction. You already get the standard deduction. Take the RMD, put charities' names on the checks, send it to the charities, and you just saved yourself about $4, $5, $6, $1,000 in taxes on $3,000. Great little planning strategy. I remember the old phrase, a penny saved is a penny earned. So the QTD is permitted from traditional IRAs and Roths only. You cannot do a QCD from a 403B, 401k, anything like that. It has to be an IRA. So if you have money in your 401k, do a trustee to trustee transfer to an IRA, then you can do your QCD. The gift must be to a qualified charity, just like Catholic Charities. And the recipient must not be a donor advised fund, which is a very, very popular way of giving today, supporting Oregon Private Foundation. Okay, so those are your requirements. All right, woo! How do your brains feel? Let me do this real quick. Let me go here.